Welcome to the Riskwiser Zone, where we navigate the twists and turns of the stock market with a keen eye for opportunity and a healthy dose of skepticism. I'm your host, Louis, and today we're going to dive into the latest insights from Jim Cramer, the renowned finance expert. As always, we'll aim to provide you with a balanced view so you can make informed decisions about your investments. Jim Cramer has been making waves with his recent stock calls, and we're going to take a closer look at three companies that caught his attention: Rivian Automotive, SoundHound AI, and Dave. Now, Cramer's opinions are always worth considering, but it's essential to remember that they're just one perspective in the vast landscape of financial analysis. Let's start with Rivian Automotive. Cramer seems to be warming up to this electric vehicle manufacturer, saying it looks like they're going to make it. He even went so far as to express his liking for Tesla, which is certainly an interesting pairing. While Rivian's last quarter was indeed impressive, it's crucial to keep in mind that the company still faces significant challenges in the highly competitive EV market. On the other hand, Cramer was decidedly bearish on SoundHound AI, stating, "We cannot be in SoundHound." He cited the company's lack of profitability as a major concern, and it's hard to argue with that assessment. However, it's worth noting that SoundHound's voice AI technologies have shown promise, and some investors may see potential for growth in this area. Lastly, we have Dave, a fintech company that Cramer seems to think has potential, but perhaps not as much as some other AI stocks. Citizens increased its price target for Dave, citing the company's ability to navigate volatility, but Cramer remains cautious. As always, it's essential to approach these opinions with a critical eye and consider multiple perspectives before making any investment decisions. We'll continue to monitor these companies and provide you with updates as more information becomes available. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of investments and market analysis, where Jim Cramer has been making waves with his comments on several stocks. Today, we're focusing on his thoughts on Thermo Fisher Scientific, NVIDIA, and other companies that have caught his attention. Cramer recently discussed Thermo Fisher Scientific, praising its strong fundamentals and impressive growth prospects. He also touched on NVIDIA, highlighting its dominance in the AI and gaming spaces. However, not all of Cramer's comments were positive, as he expressed caution about Lightwave Logic, citing concerns over its valuation and lack of revenue. It's essential to approach these opinions with a critical eye, considering both the potential benefits and drawbacks of each investment opportunity. While Cramer's insights can be valuable, it's crucial to conduct your own research and consult with financial experts before making any investment decisions. In the case of Lightwave Logic, Cramer's concerns about its valuation and revenue are valid, but some investors may still see potential in the company's innovative technology and growth prospects. Ultimately, the decision to invest in any stock depends on your individual risk tolerance, financial goals, and investment strategy. As we navigate the complex world of investments, it's essential to stay informed, adapt to changing market conditions, and maintain a balanced perspective. By doing so, you can make more informed decisions and minimize potential risks. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to shift our focus to two companies that have been making headlines in the consumer goods sector: Kraft Heinz and its struggles, as well as the resilient performance of Coca-Cola's counterpart in the packaged food industry. Highlighted through the lens of a different company, Coca-Cola not being mentioned but using another comparable example, such as PepsiCo or General Mills. First off, let's dive into Kraft Heinz. The company has faced significant challenges following its merger, with declining sales and a struggle to compete with store brands. Despite efforts to reinvest in marketing and product development, the outlook remains uncertain. On one hand, the company boasts an attractive dividend yield of around 7.28%, which may entice investors looking for income-generating opportunities. However, this must be weighed against the company's dwindling profitability and the looming specter of Berkshire Hathaway's potential exit from its significant stake in Kraft Heinz. On the other side of the coin, we have companies like General Mills, which has demonstrated an ability to navigate the changing landscape of consumer preferences. By innovating and adapting its product lines, General Mills has managed to maintain a competitive edge. This serves as a stark contrast to Kraft Heinz's struggles, highlighting the importance of continuous innovation and customer engagement in the fast-paced world of consumer goods. As we consider these developments, it's essential for investors to approach each opportunity with a critical eye, weighing both the potential benefits and the associated risks. The story of Kraft Heinz serves as a reminder that even the most seemingly solid investments can face unexpected challenges, while the resilience of companies like General Mills underscores the value of adaptability and innovation. In conclusion, the world of consumer goods is complex and multifaceted, filled with both opportunities and pitfalls. As investors, it's crucial that we remain informed, vigilant, and always ready to adjust our strategies in response to changing market conditions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.